Stop. Take a breath. Look at the markets around you. Nvidia is breaking records. Bitcoin is making headlines. The S&P 500 is partying like there is no tomorrow. But amidst this cacophony of greed, there is a silence, a heavy, unnatural silence surrounding one specific asset. I'm talking about silver. To the untrained eye, the silver chart looks dead. It looks stable. It looks like an asset that time forgot. But if you have been in this game as long as I have, you know that stability is a lie. In the financial jungle, when the water recedes from the shoreline, it doesn't mean the ocean is calm. It means a tsunami is building. Wall Street wants you to look at the price tag, let's say $30, $32, or whatever the algorithm decides today, and believe that is the value. They want you to believe that silver is abundant, that it's just a pet rock for conspiracy theorists, but they are lying to you. We are witnessing one of the greatest misdirections in financial history. While the paper price on your screen is being suppressed by high-frequency trading algorithms and massive short positions, the real metal, the physical bars, the coins, the industrial grain, is vanishing. It is being drained, it is being hoarded, and it is happening right under your nose. This isn't a market correction. This is a crime scene. And today, we are going to walk through the yellow tape, ignore the mainstream media's distraction, and look at the blood on the floor. Let's put on our forensic gloves and dig into the mechanism of this fraud. We need to talk about the rehypothecation of silver. It's a fancy word, isn't it? But in simple English, it means selling what you don't own. If you look at the COMEX, the Commodity Exchange, or the LBMA in London, you will see millions of ounces of silver being traded every single day. Volume is high, liquidity looks deep, but here's the dirty secret they don't want you to know. For every single ounce of physical silver sitting in a vault, there are upwards of 200 to 300 paper claims floating around the market. Think about that. 200 people hold a piece of paper that says, "I own 1 ounce of silver," but there's only 1 ounce in the vault. What do you call a bank that lends out the same dollar to 200 people? You call it a Ponzi scheme, but on Wall Street, they call it futures trading. My team has been tracking the registered category in the COMEX vaults. Registered means silver that is actually available for delivery, silver that can be bought and taken home. That number has plummeted to historic lows. It is hemorrhaging. The vaults are bleeding out. So who is selling? The commercials, the big bullion banks. They use massive spoofing orders and naked shorts to slam the price down every time it tries to rally. Why? Because if the price rises too high too fast, their short positions will blow up. They are trapped in a cage of their own making. They must suppress the price to survive. But here's the catch. You can suppress the price of paper indefinitely. You can print unlimited contracts, but you cannot print metal. Eventually, the physical buyers, the people who want the actual bar, not the paper receipt, will show up at the counter, and when they ask for their silver, the teller is going to look at the empty vault and panic will set in.
Now let's zoom out. Why is this shortage absolutely inevitable? Why is this different from 1980 or 2011? Because the world has changed. Silver is no longer just money. Silver is the strategic imperative of the 21st century. We are moving into an era of the electrification of everything, and physics dictates one simple truth. Silver is the most conductive metal on the periodic table. You cannot cheat physics. Solar energy. The world is racing toward net zero. Solar panels are being installed on every roof from California to Shanghai. Newer, more efficient panels, like TOPCon technology, use twice as much silver as the old ones. The solar industry alone is swallowing nearly 20% of the annual mining supply. The AI revolution. You think artificial intelligence is just software? Wrong. AI runs on chips. It runs on servers. It runs on massive data centers that require complex electronics. Every single connection, every switch, every motherboard contains silver. The military-industrial complex. Do you think that Tomahawk missiles and smart drones being used in global conflicts run on copper? No. They require the highest quality, most reliable conductor, silver. Here is the connection that should keep you awake at night. Silver demand is inelastic. What does that mean? It means Apple doesn't care if silver is $30 or $300 an ounce. There is only a tiny amount of silver in an iPhone, but without it, the iPhone doesn't work. So if the price triples, Apple must pay it. They cannot stop production. The same goes for Tesla. The same goes for Raytheon. We have a situation where demand is non-negotiable and growing exponentially, while supply is stagnant. Mine production is flat. Grade quality is dropping. It takes 10 years to bring a new mine online. We are entering a structural deficit. We are burning the furniture to heat the house. The surface stockpiles are gone. And now, nations like China and India are quietly sweeping the market, importing massive tonnage, draining the West of its real wealth. They know what's coming. They are exchanging their paper dollars for hard assets before the music stops.
So, how does this movie end? It doesn't end with a whimper. It ends with a violent repricing. We are approaching a singularity point, the short squeeze of the century. Imagine this scenario. The Federal Reserve, panicked by a recession or a banking crisis, cuts rates aggressively. The dollar index, DXY, begins to crack. Suddenly, the safe haven trade wakes up. Investors rush to buy silver. But this time, when they call their broker to buy physical metal, the broker says, "I'm sorry, there's a 6-week delay." Then it becomes a 3-month delay. Then it becomes unavailable. Premiums on physical coins will skyrocket to 50%, maybe 100% over the spot price. The disconnect between the fake paper price and the real street price will become undeniable. At that moment, the industrial giants, the Samsungs, the LGs, the solar manufacturers will panic. They won't buy to speculate. They will buy to keep their factory doors open. They will bypass the futures market and go directly to the mines, offering double or triple the market rate to secure supply. The paper market will break. The COMEX may declare force majeure, a legal clause that allows them to settle your contract in cash because they don't have the metal to give you. They will hand you worthless dollars and keep the silver. This is the super spike. We could see silver move $5, $10 in a single day. The gold-to-silver ratio, which is currently sitting at historically absurd levels, around 80-1 or higher, will collapse back to 40-1, maybe even 20-1. That means silver will outperform gold by a factor of 3 or 4. I don't predict the future. I analyze the crime scene of the present so you can prepare for the verdict. Today is December 22, 2025. We're witnessing silver trading around the $58 per ounce mark, a price level approaching historical highs. However, in today's in-depth report, I invite you to temporarily look past the short-term price fluctuations on your tickers and focus instead on a structural shift that is occurring quietly but decisively beneath the market's surface. Typically, when an asset experiences a sharp rally, our immediate concern is whether the market is overbought. Yet, current analysis of capital flows and physical inventory data tells a completely different story. We are not looking at a short-term speculative bout, but rather the inception of a systemic supply crisis. My core thesis in this report is as follows. The silver market is entering a new phase of price discovery, driven by the convergence of 3 factors: a prolonged structural supply deficit, irreplaceable industrial demand, and most importantly, a paradigm shift in the strategic reserve policies of Eastern powers. Let us begin with the most critical macroeconomic factor that the mainstream media is largely overlooking: the actions of sovereign actors. 2024 marked a historic turning point when the Russian Ministry of Finance officially allocated a budget of $535 million, approximately 51 billion rubles, for precious metals purchases over the 2025-2027 period. What is notable here is not just the figure, but the asset class. For the first time in over 50 years, silver has been classified as a national strategic reserve asset, alongside gold, platinum, and palladium. Why is this a critical signal? For 170 years, central banks have demonetized silver, relegating it to a purely industrial role. Russia's move represents a reversal of this century-long trend. Analyzed through the lens of geopolitical risk management, this is a calculated move to sanction-proof national assets. Following the freezing of $300 billion in foreign exchange reserves in 2022, nations like Russia and the BRICS Plus bloc have realized a hard truth. Only physical assets located within domestic vaults are truly free of counterparty risk. Alongside Russia, we must address China, the world's factory. Although China possesses the world's third-largest silver reserves, approximately 70,000 tons, import data reveals an unusually voracious appetite. China currently controls over 80% of global solar panel production and is growing its electric vehicle manufacturing at a rate of 40% annually. Both industries view silver as an irreplaceable input material. If we examine China's gold accumulation model from 2015 to the present, there is a strong basis to assert that Beijing is applying a similar strategy to silver, strategic accumulation to secure its industrial and technological dominance for the coming decade. The fact that the world's second and 11th largest economies have simultaneously shifted to a net buyer status for physical silver will create a hard price floor, regardless of short-term currency fluctuations. Now, let us drill down into the specific numbers from the Silver Institute and global mining data. A value investor always looks at the fundamentals, and silver's fundamentals are currently in their most severe state of imbalance in modern history. 1. Structural deficit. We are entering the 5th consecutive year of a silver market deficit. In 2024, total demand reached 1.16 billion ounces, while total supply, including mining and recycling, reached only 1.01 billion ounces. This resulted in a deficit of 148.9 million ounces in a single year. If we calculate the cumulative deficit from 2021 through 2024, the world has consumed a net deficit of 678 million ounces of silver. To put this in perspective, this figure is equivalent to wiping out 10 months of total global mining output. This volume has been drawn from above-ground stockpiles and consumed permanently. It is not returning to the market. 2. Inelastic industrial demand. Unlike gold, which is primarily an investment asset, silver is an essential industrial metal. Industrial demand hit a record 680.5 million ounces in 2024. The primary drivers are the renewable energy and high-tech sectors. 3. Supply inelasticity. This is the Achilles heel of the supply side. Approximately 70% of global silver output does not come from primary silver mines, but is a byproduct of copper, zinc, and lead mining. What does this imply? It means that even if silver hits $100 an ounce, mining companies cannot simply increase silver output if the prices of copper or zinc do not justify expanding operations. Furthermore, supply from primary silver mines is in secular decline, as easily accessible high-grade deposits have been depleted. Permitting and constructing new mines takes 5 to 10 years. We cannot expect any short-term supply surge to alleviate this pressure.
As risk managers, we must pay particular attention to the state of certified inventories. This is the market's liquidity buffer, and this buffer is thinning at an alarming rate. At the COMEX USA, registered silver,
Inventory available for immediate physical delivery has plummeted by over 50% from 152 million ounces in 2021 to approximately 73 million ounces by late 2024. In London, LBMA, inventories are also at record lows. After deducting holdings allocated to ETFs, the actual free float remaining is negligible. The danger lies in the leverage ratio within the paper market, derivatives. Currently, open interest on the COMEX exceeds the actual physical silver involved by multiples. The ratio of paper claims to registered ounces is at extreme levels, estimated around 18-1. This creates a risk of a short squeeze, similar to the nickel event on the LME in 2021, but on a much larger scale. When sovereign nations or major industrial entities demand physical delivery instead of cash settlement, the market will face an immediate liquidity shock. The divergence between the spot price and the actual cost to secure physical metal, physical premium, will widen. In such a scenario, the price listed on the exchange may no longer reflect the true value of the metal. So, is the current price of $58 to $61 the top? To answer this, we must place it within the context of comparables and inflation. First, regarding the gold-silver ratio. The ratio currently sits at 72-1, with gold at near $4,200. The historical average typically ranges from 40-1 to 60-1, and in bull markets, this ratio can compress towards 15-1. If this ratio reverts to the mean, given the current gold price, the fair value of silver should lie between $150 to $200 per ounce. Second, regarding inflation-adjusted price, the 1980 silver peak was $49. Adjusted for CPI inflation, that price is equivalent to approximately $170 in today's purchasing power. Thus, at current levels, silver remains significantly undervalued compared to its peak purchasing power in the past. 2026 to 2027 outlook. Based on the supply-demand model and macroeconomic factors, rate cuts, weakening USD, geopolitical tension, I forecast that the silver bull trend is sustainable and structural. We cannot rule out significant volatility due to spasms in the derivatives market. However, the risk is heavily skewed to the upside. When inventories breach critical technical thresholds, for example below 50 million ounces at COMEX, market sentiment will shift from speculation to panic buying to secure production supply. The current texture of the silver market is not merely a standard commodity price fluctuation. We are witnessing the convergence of a perfect storm. The greatest investment opportunities often arise when the market realizes the dislocation between price and value, and with silver, that gap is wider now than ever before. Thank you for your attention.